Welcome to the deep dive. Today we're looking at gold. It's obviously been around forever as a store of value, but maybe feels extra relevant with the markets being so, well, choppy in 2025.
Definitely. And specifically, we're exploring this idea you might be hearing, buying the dip in gold. This is as of May 27th, 2025.
Yeah, and our guide for this is an article from moneyflows.com by Alec Young. It's actually titled Buy the Dip in Gold.
Right. So our plan today is to really unpack the arguments from this specific article. Why does this author think gold might be a good addition now? How does it fit in a portfolio? What ways does he suggest getting exposure?
And crucially, we're sticking only to what's in the source material for this discussion.
Exactly.
Okay, so context. The article paints a picture of 2025, highlighting what it calls epic volatility.
Yeah, and it makes a point right away that even though gold recently pulled back maybe 10% according to the piece,
It's still having a very strong year.
a really strong year. The author notes it's still up over 20% year to date and compares that directly to, well, a lot of other major asset classes that it says gold is outpacing. Things like Bitcoin, large cap stocks, mid caps, small caps,
The international stocks, too.
international equities, yeah, and various kinds of bonds as well, all mentioned in the sources lagging gold this year.
Okay, so even with a dip, it's leading the pack, according to this analysis. That really sets up the author's main argument, doesn't it?
It does. The core idea presented is, yes, consider buying this dip, but also think about gold more structurally. The article suggests it deserves a permanent, though maybe smaller, satellite allocation in your portfolio.
Right, not just a short-term trade, but something you hold alongside your core investments.
Exactly. That's the perspective in this piece.
All right, let's get into the why. What about gold's performance track record, according to the article? It does admit gold can be streaky, right?
It does use that word streaky. It
Mhm.
notes gold tends to shine brightest when there's more uncertainty around. Things like, high inflation worries, geopolitical tensions, maybe unpredictable policy decisions.
And the flip side.
On the flip side, the article suggests it might lag a bit when the overall economic picture feels, calm and stable. Benign macroeconomic backdrops is the phrase used.
Okay, but streaks aside, what about the long haul? Does the author make a case for its long-term performance?
Oh, definitely. The article makes a pretty bold claim here. It says, over the long run, gold has, quote, crushed bonds.
Crush bonds, strong words.
Yeah. And it says gold's been very competitive with stocks. It even specifically claims, referencing a chart we don't have, but noting the claim that gold edged out the S&P 500 over the last 20 years.
Interesting claim. And that's on top of the 2025 performance we already talked about, up over 20%, beating those other assets.
Exactly. So the picture painted is one of, yes, short-term ups and downs, but a potentially strong performer over longer periods.
But the author stresses it's not just about the price going up.
Correct. That leads into what I think is a really central part of the article's argument. Gold is a portfolio diversifier.
Okay. Diversification is always important, but maybe especially in volatile times, like the article describes 2025.
Absolutely. And the author points out a common challenge. A lot of the typical risk assets people own, they tend to, well, move together. They rise and fall in sync.
Like, say, large company stocks and maybe high-yield bonds.
That's an example the article uses, yeah. They often move in lockstep. So the piece then brings up long-term treasuries.
The traditional diversifier.
Right. Widely held. And the article acknowledges they do offer true diversification because they usually rally when investors get scared and risk sentiment sours. They can cushion the portfolio.
But there's a catch, according to the author.
Yes, there's a catch highlighted with treasuries. The article points to their history of, let's say, mediocre returns,
Okay.
and also the potential for significant downside risk if interest rates were to climb and stay high for a long time.
So if treasuries have that drawback, what does the article propose as a better solution, or the holy grail, as it puts it?
It uses that exact phrase, holy grail.
Hmm.
It describes the ideal investment as something that performs well and reliably zigs when everything else zags.
And that's gold.
And the article says gold fits the bill beautifully.
What makes it zig, according to this piece? What are those diversification properties?
Well, the article details gold's low correlation to a whole range of assets. Things like high-quality bonds, high-yield bonds, stocks of all sizes, large, mid, small caps, and even international stocks denominated in dollars.
Low correlation, meaning its price doesn't just follow the crowd.
Pretty much, yeah.
Yeah.
Its movements tend to be independent of those other investments.
Okay, that's good for diversification. But you mentioned something even more powerful.
Yes, this is probably the single most important diversification point the author makes. It emphasizes that gold is very negatively correlated to the US dollar. Again, referencing a chart we can't see, but stating the finding.
Negatively correlated, so when the dollar goes up, gold tends to go down and vice versa.
Generally, yes. And think about most of the assets we just listed. Stocks, bonds.
They're priced in dollars.
Exactly. So the article argues this negative link to the dollar actually supercharges gold's diversification power. If the dollar is moving and affecting your other assets, gold tends to provide a counterbalance.
Ah, I see. It really helps explain that zig while others zag idea the author puts forward. Makes sense.
Yeah, it's a core part of the thesis.
Okay, so we understand the performance and diversification arguments from the source. What does it say is actually driving the demand for gold right now?
The article breaks down global gold demand into four main buckets, using percentages from a source chart. Jewelry is the biggest slice, at 43.7%.
Okay.
Then you have investment demand, that's 25.7%. Central banks are next at 23.6%.
Right.
And the smallest piece is technological uses, think electronics, dentistry at 7.1%.
Right, so central banks are nearly a quarter of demand, but the articles seem to flag their activity as particularly important.
It really does. It highlights that even though it's 23.7% of total demand, that central bank segment is actually growing the fastest.
Fastest growing, how fast?
The author gives a specific data point. Central banks bought 1,086 tons of gold in 2024. That figure, it says, is more than double the 450 tons they bought back in 2021.
Wow, more than doubling in just 3 years. That is a significant jump.
It's a huge shift.
Does the article say which central banks are leading this charge?
It names some specific emerging markets. China, India, Poland, and Turkey are listed as adding the most to their gold reserves since 2019.
And the reason? Why the sudden surge in buying from these central banks, according to the author?
The article connects it directly to geopolitical uncertainty. It argues this uncertainty is driving demand for assets seen as an alternative to holding vast reserves of U.S. dollars.
An alternative to the dollar.
Yeah, and it specifically mentions China's increasingly competitive relationship with the U.S. as a factor, suggesting this trend of central bank gold buying isn't likely to stop soon.
That's a really interesting geopolitical angle driving demand, according to this source. It also mentions the article includes a ranking of global central bank holdings, right? Yeah.
It does, yes. Acknowledges a chart showing that ranking is in the original piece.
Okay, so we've got the author's view on performance, the diversification benefits, especially against the dollar, and these demand drivers like central banks seeking dollar alternatives. So for you, the listener, thinking practically, how does the article suggest actually investing in gold?
Good question. The piece moves into portfolio construction and lays out two main ways to get exposure. One is owning physical gold bullion directly.
Like gold bars or coins?
Exactly. Holding the actual metal. But the article quickly points out some pretty significant drawbacks.
Such as?
High dealer fees when you buy or sell. It can be expensive to insure and difficult to store securely if you have a lot of it.
Okay.
And a big one, particularly for U.S. investors, taxes. Physical gold, the article states, is taxed as a collectible. That means ordinary income tax rates, not the potentially lower long-term capital gains rates you get on stocks or ETFs.
Ouch. So higher costs, storage hassles, and less favorable tax treatment. Sounds like the author isn't a huge fan of physical bullion then.
Not the preferred method, no. The article's quite clear on that.
So what is the recommended approach in the article?
It explicitly recommends gold ETFs exchange-traded funds, and specifically holding them in tax-deferred brokerage accounts. The article calls this the way to go for bullion exposure.
Makes sense for avoiding those tax issues, at least until withdrawal, but it also says not all gold ETFs are the same.
Correct. It brings up GLD, the big one from State Street, calls it the category leader, widely known, very liquid. But the article notes its annual expense ratio is, quote, high at 0.4%.
Okay, 0.4% per year. Is there an alternative suggested?
Yes. The author introduces GLDM, which is also from State Street. It was launched more recently in 2020, positioned as its cheaper alternative.
And cheaper means, what's the GLDM expense ratio mentioned?
Significantly lower, according to the source, 0.1%.
Quite a difference. 0.1% versus 0.4%.
Exactly. So the article's conclusion here is pretty direct. If you want exposure to gold bullion via an ETF, buy GLDM.
Got it. GLDM for cost-effective bullion exposure, based on this source. Now, what about the second route mentioned, investing in gold mining stocks or royalty companies?
Right. The article acknowledges that, yes, a rising gold price generally helps these stocks, but it adds a major warning. You have to be very choosy.
Very choosy. Why is picking the right mining stock so tough, according to this piece?
The author lays out several reasons. Finding new gold or expanding existing mines, what they call organic growth, is just inherently difficult.
How so?
It takes a long time, it's incredibly capital intensive, needs a lot of labor, and often these operations are in remote locations or countries with significant political risks. Risky overseas jurisdictions is the term used.
Okay, lots of hurdles. And this difficulty creates what the article calls
A huge performance gap, that's the phrase. A huge gap between a few, what the author deems elite gold stocks, and, well, most of the rest.
and it names names of underperformers.
It does give examples of big, well-known mining companies, Barrick, ticker ABX, and Newmont, NEM, that it says have actually underperformed significantly for years, despite being household names in the sector.
Which leads to a problem if you're thinking about using an ETF to invest in miners.
Precisely, because these big, potentially underperforming companies dominate the standard market cap-weighted gold mining ETFs.
The ETFs end up reflecting that underperformance.
That's the conclusion in the article. It calls those broad market cap-weighted mining ETFs a poor choice.
So what's the alternative for mining exposure then, according to the source? Just pick individual stocks carefully.
Essentially, yes. Highly selective stock picking. The author mentions their own money flows scoring system, which they use to try and identify the better prospects by following where big institutional money is going. They note some specific stocks identified this way, shared with subscribers in the original context, were seeing buying even during gold's recent pullback.
Okay, so the takeaway on miners from this article is tread very carefully, avoid the broad ETFs, and focus on identifying there's few elite stocks if you go that route.
That sums up the author's guidance on mining equities, yes.
Well, this has been a really useful walkthrough of the key arguments in this specific moneyflows.com article about buying the dip in gold. Let's maybe just quickly recap the main points the author wanted readers to take away.
Sure. So the article argues for considering the recent dip in gold. It points to, 1, strong recent performance over 20% year-to-date, remember, outpacing many assets even with that pullback.
And 2, a solid long-term track record presented in the piece, even claiming it beat the S&P 500 over 20 years.
Right. Then 3, the powerful diversification benefits. Gold's low correlation to most assets, and especially that negative correlation to the US dollar, making it that zig when others zag.
The holy grail diversifier, as the author put it.
Exactly. And 4, the demand drivers, particularly that accelerating central bank buying.
Driven by geopolitics and the search for dollar alternatives, naming China, India, Poland, Turkey.
Precisely. And finally, 5, the how-to, the strong recommendation for GLDM as the cost-effective ETF for bullion exposure.
And the warning to be highly selective with mining stocks, avoiding the broad market cap ETFs.
So understanding these specific points from this one analysis might give you, the listener, some valuable context as you navigate these volatile markets and think about your own portfolio. It lays out the author's case for why gold might deserve that permanent satellite spot.
Definitely food for thought. And as we wrap up our deep dive into this source material, here's a final idea to ponder, building directly on what the author presented. Given the article's strong emphasis on central banks buying gold due to geopolitical shifts and wanting dollar alternatives, what might this analysis imply about the author's underlying view on potential long-term changes in the global financial system? And where does gold fit into that bigger picture, according to this perspective?